What's up, everybody? Austin here. Got a quick update. I am selling my shares of Tesla and I am buying shares of Dividend stock, Advance Auto Parts. I'm going to do this on Monday and I'm going to talk about why. This is directly from my email newsletter. My subscribers got it over the weekend. The link is down in the description, austin.substack.com. Here's the portfolio update. Current value $147,000, $147,400. I don't know why I always mess that up. In total, since February 15th, 2022, we're up $11,256, which is showing us 13.53%. Tesla, you can see, is the largest position. We are up on the position. And then we've got Taiwan Semi, Brookfield, Meta, Alibaba, Google, Rocket Lab, Snowflake, Datadog, Pinduoduo, Mercado Libre, and Brookfield Asset Management. Their holding company or their management company. And we're going to be obviously getting rid of Tesla and adding Advanced Auto Parts. So here's why. And if you like this stuff, then check out my email newsletter, because this is what goes into my email newsletter. And it's just a good place for you to get all of these things directly in your inbox instead of having to find them on YouTube. Stock is just ridiculously expensive. I believe they're one of the best automakers in the world. I believe they're going to keep innovating and move into higher gross margin segments like full self-driving software, energy storage, robotics, and I believe that the company will be worth more in the future than it is worth today. But I also believe that much of that is already priced into today's share price, and they have a long way to go before those things begin to move the needle. Here's a chart from Fast Graphs. If you look on the right side down here, you see a blended price sales ratio of 8.04. The orange line represents the average price sales ratio since 2009 of 9.9, right? So you can see it right there. Normal price sales ratio at 9.9. So you might think shares are undervalued. But here's the thing. Every dollar we have invested into a company is a dollar that could be invested into another company or kept in cash. Right now, as excited as I am about the future of Tesla, I can't justify continuing to own shares when it's so much more expensive than other companies I could own. Tesla is trading at a forward 3-year price to earnings multiple of 29, while Google is at 13, Datadog is at 52, and Taiwan Semi is at 12, and Advanced Auto Part is at 11. It's also trading at a premium enterprise value to sales multiple. So you can see here, we'll zoom this in a little bit. Price to earnings currently, or forward 1 year, Tesla's at 50, Google's at 18, Datadog's at 88, Taiwan Semi's at 16, and Advanced Auto's at 12. Fast forward to 3 years from now, and those are the numbers we just talked about. See how much higher Tesla is. And then if you look at an enterprise value to sales forward, Tesla's at 5.9, Google's at 3.78, Datadog's at 14.89, Taiwan Semi's at 5.8, and Advanced Auto is at 1.16. Then price to cash flow, trailing 12 months, Tesla 42, Google 13, Datadog 60, Taiwan Semi 9, and then Advanced Auto Part 13. Okay, one argument could be that Tesla deserves to trade at a premium multiple. If that's the case, then it either needs to grow a lot faster than my other investment options, or it needs to be more profitable. Tesla's gross profit margin is currently 25%, while Google is 55%, Datadog is 79%, Taiwan Semi is 59%, and Advanced Auto is 45%. As a reminder, gross margin is the amount of money a company has left after subtracting all direct costs of producing or purchasing the goods or services it sells. Tesla's free cash flow margin is 5%, while Google is 18%, Datadog is 25%, Taiwan Semi is 11%, and Advanced Auto is 1.93%. So Tesla does not stand out from a profitability standpoint as deserving a premium multiple to these companies. Here's the chart right here. You can check it out. It's also in the email newsletter. I won't run through all of it. Through 2027, analysts are expecting revenue for Tesla to compound at 23% per year, resulting in $228.5 billion in annual revenue in 2027, which is up from $81.5 billion in 2022. So top line right here, these are analyst expectations, $228 billion in 2027, up from 81.4 billion last year. That's a compound annual growth rate of about 23%. Analysts are expecting 2027 income margin of 14% and a free cash flow margin of 17%. So let's do a simple 5-year bear, bull, base, and bull case scenario using those expectations as a baseline. We're using a low, middle, and high revenue growth of 19%, 22%, and 25%, and a profit margin of 13%, 15%, and 17%, and then a free cash flow margin of 12, 15, and 17. We're using a PE ratio. It's right now it's at 49, but 5 years from now, as you know, growth is starting to slow down, a PE of 18, 20, and 24, and then a price to free cash flow of 18, 20, and 24. Same thing. Desired annual return of 10% per year. With those numbers in the low scenario, stock's worth $100 today. That's what we would be willing to pay. It's currently at 196. Middle scenario, it's at 142, which is, I don't know, 20, 25% lower than it is today. And then the high scenario, 210, which is about 10% higher than it is today, or a little bit less. So for this investment to make sense, you need the high scenario to work out. 25%, 17 revenue growth over the next 5 years, profit margin of 17%, and a PE of 24, and a price free cash flow of 24. If you believe these numbers to be true, you'd need the high scenario to play out. We just talked about that. Now, what if my expectations were too low? What if it gets a higher PE? Well, with 25% revenue growth and a PE of 40 5 years from now, the current fair value is 331. So that's definitely higher than it is today. You'd be willing to pay $331 to get 10% a year, and the share price is 196. So if you believe that to be true, 25% revenue growth, PE of 40 5 years from now, you would be buying Tesla all day long right now. With 30% revenue growth on a PE of 30 5 years from now, the current fair value is 309. So either of those scenarios would make you a pretty happy buyer of Tesla stock today. I already laid out my 5-year scenario for Google in the last email, which is another stock we talked about. I would rather own Google. I just think it's more bullish based on its growth, its profitability, and the current PE multiple and price free cash flow multiple. But I'm going to be adding Advance Auto Parts, which is kind of crazy. Now I'm going to bring all the trolls out of the woodwork and talk about why I'd rather own Advance Auto Parts over Tesla right now. Okay, yep. Through 2026, analysts are expecting revenue to compound at 2.6%, resulting in $12.5 billion in revenue, up from $11 billion in 2021. So not much growth there. Analysts are expecting a 2026 income margin of 7.6% and a free cash flow margin of 7.3%, with $6.75 dividend per share, up from $3.25 today. So almost more than doubling the dividend payment between now and then. So same 5-year scenario. We're using low, middle, and high revenue growth of 2%, 3%, and 5%, and a profit margin of 5%, 6%, and 8%, and then a PE of 12, 14, and 16, with a 10% desired return. If we look at this image, here's those numbers. There's the low, the middle, and the high. And you can see right here, current share price 151. The low is 114. The middle is 159. So you'd be a buyer in the middle scenario if you believe this to be true. And in the high scenario, you'd be willing to pay 255 today and still get your 10% desired annual return. Now, which scenario do I believe to be most likely to be true? That's what investing is about. It's about assumptions. The middle or high scenario for Advance Auto, where you're needing 3% or 5% revenue growth, or 25% plus revenue growth, and then a PE of somewhere north of 25. Right now, I just believe that this is more likely to be a profitable investment for, the next 3 to 5 years than Tesla. That's the decision I'm making, right? This scenario gives investors a better outcome in the next 5 years than Tesla. It also doesn't take into account share dilution and buybacks, which is an important part, not factored into everything I just did above. Over the last 5 years, Tesla's shares outstanding have increased by 25%, while Advance Auto shares outstanding have decreased by 20%. So when you get more shares of a company, all the companies that investors own today are worth less in the future because you're spreading all the profits, the sales over more shares and more shareholders, essentially. When you have less shares, every share is more valuable than it is today. And so you can see this chart right here. Tesla's purple over the last 5 years, up 25%. Advance Auto is orange, down 19.9%. That's a big difference there, and that really helps make up for, some of that lack of growth, right? Scenario also doesn't take in dividends, which Advanced Auto currently yields roughly 4%, which if it pays a 4% dividend, you get a 4% gain annually just from the dividend alone. Tesla does not pay a dividend. So on Monday, this is tomorrow, February 14th, I think, 13th, I'll be selling $16,709 of Tesla and buying $16,709 of Advance Auto. I can already see the hate mail and the hate comments I'm going to get. That's fine. I'm not trying to make anyone happy. I am trying to build long-term wealth, and I'm sharing my thoughts, my decisions, and my performance along the way. If you like this content, you can actually hit the little heart of this video and contribute. That helps me make money from this video. You could do as little as $1.99. I don't ever want to do brand partnerships on here where I'm saying, hey, this video is sponsored by this brand, okay? I do have YouTube ads on, but the more money that I get supported by subscribers, the less I need to do to support this channel and the more ability it gives me to keep this channel going. So you could do a gesture like that for like $1 or $2 or whatever you want. You could subscribe to my email newsletter, austin.substack.com. And for free, you could subscribe to this channel, or you could just like the video, leave a comment that helps YouTube push it out to more people. So if it's valuable and you're learning, that's how you can help more people learn, and that's how you can help support me. Thanks so much for watching. I appreciate you, and let me know what you think about this decision in the comments.